This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone and welcome back to the channel. Recently, one of my audience reached out and told me that Brompton has launched a brand new ETF called PAYG. When I first saw its structure, my first impression is that it would be an interesting fund. It pays out twice every single month, with each distribution sitting at 0.20 Canadian dollars per share. If you calculate that based on the initial offering price of $25, the annualized dividend yield comes out to roughly 20%. In our current economic environment, a payout level like that is truly eye-catching. After doing my own research and giving it some serious thought, I have decided to buy in and officially replace my current holding of Evolve's INTY with this new ETF. So today, let's take a systematic look at what exactly makes this fund so special. First, let's look at the basic facts of the fund. PAYG was officially launched on March 30th, 2026, and is managed by Brompton Funds Limited. It is an actively managed fund that aims to achieve the dual goals of capital appreciation and high-frequency distributions by investing in leading companies across various global industries. According to official documents, its management fee is 0.6%, which falls within a very reasonable range for an active high-income fund. Another feature worth mentioning is that it utilizes a CAD hedged strategy. For those of us investing here in Canada, this is extremely important because it not only helps us avoid the uncertainty of exchange rate fluctuations, but also ensures our investment returns more closely reflect the performance of the underlying assets in our own currency. Whether you are using a TFSA, an RRSP, or a regular taxable brokerage account, PAYG is fully eligible for holding. On a strategic level, PAYG primarily achieves its high distribution goals through two core methods. The first is a covered call strategy, which involves selling call options to collect premium income, providing the fund with a steady stream of cash flow. The second is maintaining a leverage ratio of approximately 25% to modestly amplify the returns of the underlying assets. This specific combination of premiums and leverage allows its distribution capacity to be much higher than the typical high-yield fund, making it appear quite competitive compared to similar products. Now, let's take a look at the investment portfolio. When choosing an ETF, the first thing you have to look at is the holdings, and the portfolio of PAYG could be described as a classic global all-star lineup. The entire mix covers semiconductors, AI, biopharmaceuticals, energy, financials, and consumer staples, providing a balance of both growth and defensiveness. Within the growth sector, semiconductors and AI are the most important allocations. The fund holds ASML, TSMC, Broadcom, and NVIDIA. These companies essentially control the global AI computing power and chip ecosystem, playing a very strong leading role during technology cycles. For the defensive portion, PAYG has invested in Johnson & Johnson, Walmart, and Eli Lilly. These companies maintain solid profitability even during periods of economic volatility, especially Eli Lilly, whose leading position in the weight loss drug market makes it one of the few growth representatives outside of the tech sector. Regarding energy and resources, the fund is allocated to GE Vernova, BHP, Agnico Eagle Mines, and Shell. These assets can not only handle inflationary pressures but also provide natural protection when energy prices rise. Furthermore, the financial and logistics segments include UBS, Citigroup, and FedEx, which stand to benefit from the recovery of global trade and interest rate cycles, serving as the cyclical support for the portfolio. In terms of geographical distribution, allocation is also very globalized. Although most of the stocks are traded on the US market, its business footprint covers the entire world. The US portion includes tech giants like Microsoft, Amazon, and Google. The European side features ASML from the Netherlands, UBS from Switzerland, and Shell, while the Asian side holds TSMC and Sony. Interestingly, they have also invested in Pinduoduo and Alibaba in the Chinese market. The inclusion of these two Chinese concepts can be seen as a strategic contrarian play. Given their currently suppressed valuations, their high volatility actually helps the fund generate higher premium income through its option strategy. Overall, this list of holdings consists almost entirely of industry leaders with stable cash flows, which aligns perfectly with the fund's goal of pursuing high yield and stable appreciation. If your investment portfolio already includes an S&P 500 or NASDAQ index fund, PAYG can play a complementary role. Its 40 to 50% allocation to non-US stocks and traditional industries can improve your defensiveness and enhance your overall cash return capacity. Looking at historical backtesting, the portfolio performance of PAYG has been quite impressive. Although GE Vernova has not been listed for very long, and the full portfolio's historical statistics only cover about 2 years. The cumulative return during this period has reached 40.46%, which outperforms the Nasdaq 100 index. If we exclude G Vernova and backtest using earlier components, the long-term performance over about 8 years still reaches 26.49%, continuing to surpass the Nasdaq. Moreover, the historical maximum drawdown of this portfolio is also lower than that of the Nasdaq. It is clear that the fund manager possesses significant strength in combining active stock picking with option strategies, successfully increasing the yield while maintaining relatively controlled volatility levels. Regarding the specific covered call strategy of PAYG, the coverage ratio is around 40 to 45%, and they write call options that are 2 to 3% out of the money. Under this strategy, if the investment portfolio can maintain an average growth rate of approximately 26%, this upside potential should be enough to cover the 20% dividend payout. Therefore, I personally have quite a bit of confidence in PAYG to maintain its net asset value. Of course, even though PAYG historical backtesting looks good, we should not ignore the fact that it remains a highly concentrated investment portfolio. Naturally, it is difficult to achieve a 20% annualized distribution yield by relying solely on broad indices. Risk and return are always relative. If you need high distribution, you must take on a certain amount of risk. Personally, while I still like index funds, since I am now at a stage where I need to rely on distribution for my living expenses, I inevitably have to chase higher distributions. This move to swap INTY for PAYG will actually result in a slightly smaller distribution, but compared to the covered call strategy of the Evolve Ultra Yield series, I personally prefer PAYG from Brompton. Relatively speaking, their covered call strategy is more conservative, and my expectation for PAYG is that it can maintain its distribution while still allowing the net asset value to achieve a certain amount of growth. At the same time, Brompton as a fund company is actually quite conservative when it comes to launching funds. They don't just release a fund because of a market trend, and their funds usually offer good long-term returns. So, subjectively, I have a strange sense of security with PAYG, though that is just my personal feeling. Personally, my plan is to pair ZEQT.T with PAYG and continue to steadily increase my positions in both. When you look at them closely, the geographic allocation of PAYG actually mirrors ZEQT.T quite a bit, which is one of the reasons I find the combination so compelling. I've always viewed ZEQT.T as one of the most stable and reliable investments you can hold, and I'm particularly bullish on this fund because, at its core, it is essentially the same high-quality foundation as the original ZEQT. The real advantage here is that because its payout rate is capped at a very sustainable 6%, I believe it's going to do an excellent job of maintaining and protecting its net asset value over the long run. Now, if there's one downside to mention, it's that the annualized dividend yield is on the lower side compared to some of the more aggressive funds. However, when you are dealing with a product from a major institution like BMO, you can't really expect them to be overly aggressive or take unnecessary risks with the structure. In a lot of ways, that conservative institutional approach is actually a good thing for peace of mind. To bridge the gap and meet my cash flow needs, my strategy is to consistently purchase more of both PAYG and ZEQT.T. By holding these two together, I'm confident I can achieve a much healthier and more consistent boost to my overall monthly income. That's all for this video. If you found it helpful, please remember to like, comment, and subscribe. Thank you for watching.